Okay, great stuff. So this is the next video. So now we're on to financial assets. There is a, I mean, there is a straightforwardness to this here. We're talking about you now. When we talk about financial assets, fundamentally, in your syllabus at least, we're focused on typically equity and, of course, holding debt. So when I say you've sold, um, if you like, you've sorry, forgive me, you've bought debt. So you've bought, and or in other words, you've loaned money to someone or to a company. So you are expecting finance income basically interest every year or something along those lines. So really, that's what we're really dealing with here. The standard really looks at the recognition and measurement of financial assets, and of course, this is about contracts again. So an entity should really recognize a financial asset on a statement of financial position when and only when the entity becomes party to the contractual provision of the instrument. So at initial recognition, all financial assets are measured at fair value. Again, this is likely to be how much you have paid for the financial asset. Now, of course, yeah, I think that's the first thing. We'll talk about transaction costs. Yeah, here we are. So transaction costs, if the asset is fair value through profit or loss, and we'll see what that means, and you'll see when I talk about equity in a second, which will be the first financial asset I'm dealing with. So because really the idea of fair value through profit or loss is almost saying that this is for trading purposes. When I say trading purposes, you're looking to make profit on this as we go along. So the idea really is that all transaction costs are therefore excluded because this is just for trading. So everything is going through the income statement anyway. But if you intend on holding it for the long term, if you like, and that applies with this idea of fair value through other comprehensive income. The principle is if that's the impression, if you the designation, if you like, then you are allowed to, if you like, capitalize those costs. So as you can imagine, you have here's the asset itself that you've just bought out of the bank. You've paid via the bank, and you have to pay these transaction costs. You would capitalize those transaction costs as well as what they're telling you, if it is fair value through other comprehensive income, which I'll talk about, or amortized cost. Let's talk about equity. So pretty straight. I think I have on several occasions talked about that spectrum of having greater than 50% of an organization. So here, of course, we carry out its business combination where we consolidate the business with ours. And if you have between 20 and 50%, we deal with it as we would an associate. But if you have less than 20%, the impression is that you're really holding this thing to trade. So you imagine you're holding 10% shares in a listed company. You know, you've paid for it. It's sitting on your statement of financial position. The whole idea is that as it increases in value, or you're holding it because you believe it'll increase in value, you just feel it's better than holding cash, probably, and therefore you'd sell it once your broker advised you that this made enough money now, let it go. Otherwise, you might be out. You might be in that situation where you're out of the money for it. So really, the argument here is for these type of listed shares where you're holding less than 20%. Small amount, you want to be recognizing the fair value through profit or loss. What does that mean? If you bought some shares for £3, if you bought 1,000 of them, you paid, if you like, £3,000 for them out of the bank, and then by the end of the month they've increased by another, I don't know, £1. So literally that extra £1 times the 1,000 you recognize straight away into the statement of profit or loss as a gain of £1,000 straight away, and your shares are now worth £4,000, and that's what they're really saying to you. Recognize the movement straight away. Again, like I say, these are typically where we're dealing with listed shares. It is possible to be holding shares in a private limited company, which is not being traded on the stock market, and as a result, that can also increase in value. But because they're not being traded, you don't typically have any intention of trading them. So the idea here is then what do you do? So let me just go through the slides. I'll come back to that point I was just about to make. So fair value through profit or loss. This is the default position for equity instruments. Any transaction costs, of course, are expensed and not capitalized. The investments are then revalued to fair value at each year, with the gain, of course, loss being shown in the profit or loss. You would do this anyway. You would just revalue as often as possible and put the gains through profit or loss. Now, like I said, if you're not intending to sell the asset, and if the investment is not held for trading, then the investment can be classified as fair value through other comprehensive income. And typically the principle is that once you have chosen to do this, you cannot change it to fair value through profit or loss. Now, what does this mean? This really means that under this method, the idea is you're sort of assuming that you're going to hold this for the long term, kind of like almost like an amortized sort of ground. You intend to hold these shares for the long term. You have no intention of selling them. So what were we saying? We revalue to fair value anyway each year, but all the gains and losses, the gains or losses, forgive me, are taken to an investment reserve in equity and shown in other comprehensive income. So basically the movement or the gains or losses do not affect our income statement, our statement of profit or loss. It just goes into other comprehensive income, and from there goes into, if you like, this investment reserve in equity, really, right? And that's really the point, really. And when we do this, well, again here, this is similar to the revaluation of PPEIS 16. If you like, the difference here is you can have a negative investment reserve where you have a fall in the value of that equity, but that doesn't hit your income statement as opposed to IAS 16, which would, right? And that just goes straight to that statement of that reserve. So here an example here would be, and we will see there's a TYU on it where you've bought some shares. Let's just stick with the same thing, £3,000, bank £3,000, and let's just say that the shares had fallen in value by 1,000. So you have 1,000 here in those shares, but you don't put it through the income statement. You put it through this, if you like, other comprehensive income, and you have 1,000 here on the debit side, and you transfer this later to the investment reserve, even though it's negative. Yeah. Cool, great stuff. Yeah, I think I think it's good to do it that way so I can clearly separate out, because I've just been talking about equity as a financial asset. I mean, that is equity, financial asset. That's the first one. Your key financial assets that, like I said, I addressed that you'll be dealing with, of course, are you holding equity or you holding debt? And I'll talk about that in the next video. It's good we do that in a completely separate video. Cool, great stuff. See you in the next video.